Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Has the bar been set low on the Q2 earnings season? Well, our research director, Shiraz Mian, is here to give us the answer to that question.
And the answer is yes.
It is.
Yeah.
All right.
So the estimates have come down, and it is a low bar.
All right. So low expectations set up the possibility of upside surprises.
That's true as well. Are you on a track of just getting positive answers from me?
Well, that said, is the bar so low this time around that anything good is going to seem good, anything positive?
Yes, to that as well. And it's not just the estimates for the June quarter, but also estimates for the September quarter and beyond. Everything is so low and depressed that anything positive will be interpreted as a turnaround on the earnings picture. In effect, 2019 has been written off from a growth perspective. All eyes are on 2020 and beyond. Now, around this time, perhaps in the September quarter, we should start getting more clarity, visibility, and outlook for 2020. We wouldn't be hearing a lot of that this time. But any signs that growth is perhaps better than what everybody's pricing in will be a positive, yes.
All right, so what I'm hearing out on the street is that analysts are calling for around a 3% decline for the second quarter.
That's
earnings.
correct.
Would you characterize that then as being bleak or just in the caution zone?
I definitely not bleak. The reason why we had a modestly negative finish for the first quarter, and the 3%, yes, that's what our estimates show too, and a little bit of a negative growth rate for September quarter too. It is solely because the base period, which is each of the corresponding quarters in 2018, are so huge and so big and so strong that anything in comparison looks just not up to the par. So a 3% decline from all-time record levels last year, I would say, is still a good showing.
All right, what about these companies exposed to tariffs? Are they going to take a particularly strong hit this time?
Yes, it is. In fact, even at this very early stage, Terry, when it's only the banks that have reported, even from those guys, we are hearing indirect effects on the businesses. So whether it's Citigroup discussing the outlook for Asia or JP Morgan discussing trends in the loan portfolios, even they are referring to this tariff issue and uncertainty about trade. So yes, as we move further along into the earnings season and we get into players that have a more direct impact, we heard that from FedEx already, which has reported and has a more of a direct exposure to the trade issue. So yes, trade has become a big headwind overall for corporate earnings.
All right, as you said, the banks kicked off the parade for the Q2 season. What's been reported so far?
Yeah, so I have a slide that I want to share with folks here, as you could see here. So it's all the major banks. They have reported already: Citigroup, JP Morgan, Wells Fargo, Goldman Sachs. This accounts for about a fifth of the finance sector's total market cap. The growth picture is better, as you could see on the left-hand side chart, which compares the growth for the companies that have reported with what we had seen from the same group in Q1 19 and the 4-quarter average and the 12-quarter average. And the right-hand side chart compares the proportion of positive surprises. So 75% are beating EPS estimates, 62.5% are beating revenue estimates, and earnings are up 5.6%, revenues are up 2.5%. Good, not great. We mentioned briefly the trade issue. That's something, an indirect effect for these guys. interest rates is a much bigger issue for them. We heard from J.P. Morgan that the net interest income, the outlook for the second half of the year, they lowered that a little bit because they factored in a Fed interest rate cut. And many in the market are pricing in more than one interest rate cut. So
Three, I think, is the number I heard.
3 is the number, exactly. So even though some say that the market is perhaps a little too optimistic on that front, but any interest rate cuts is a cut for bank profitability too. So we are seeing that in their outlook as well as in the estimate revisions trend for banks as a whole. But overall, the results thus far are good.
And let's clarify, you put this group in the just good category.
Yes, so there's not a lot of good when we look at all of the 16 sectors for the S&P 500. You mentioned earlier about 3% decline in earnings for the index as a whole. Finance is one of the positive ones. So about half of the 16 are expected to experience year-over-year declines. Technology, among the big ones, is expected to have a 10% year-over-year decline in earnings. So even before the earnings season got underway for banks, they were expected to have a 2.5%, 3% earnings growth. So yes, I would put finance in the good category.
Just good.
Just good.
Okay. Did I hear you say earlier that these earnings are going to slide right through Q3?
Yes. So the current expectation is, and I have a slide that I'll share with you in a little bit, but the expectation currently is for about 1.5% decline in the September quarter and a modestly positive growth in the December quarter. Now, typically what happens is that as these June quarter results come out, many companies guide lower, and as a result, analysts cut their estimates. So my feeling is that by the time we are through with the Q2 earnings season, this 1.5% decline for the September quarter will have come down to 3-4% decline. But right now, it's 1.5% decline.
Is all this setting the stage for an earnings recession this year?
You know, technically speaking, and let me share that promise chart that I mentioned earlier. So in the middle of this chart, Terry, for Q1 we have a 0.1% decline in earning. The quarter earnings season we are going through now is now 2.5% decline. It was 3% decline, as you pointed out earlier, but with these bank results coming in better than expected, it's improving a little bit. And now for the September quarter, it's a 1.9% decline. Now, when you have 3 quarters back to back with a negative in front of the growth rate, that by regular definition of a recession would qualify there. But as we discussed earlier, when we say recession, it has a whole bunch of other connotations associated with them. It's typically used in the context of the economy when GDP growth is contracting. Now here it is a decline, but it's primarily because the comparisons to last year are so tough. So yes, earnings are declining, but I wouldn't call it an earnings recession though.
And am I looking at a little bit of a rebound in Q4?
Yes, so there is a 3.9% rebound in Q4, and then as you could see in this chart as well, there's a 9.4% rebound in the first quarter of 2020.
Even with that slight rebound in Q4, is this year, 2019, going to be a flat year for earnings? You
started with getting these positive answers from me, and it looks like you're continuing that trend. Yes, the answer to that is, and I have a chart to share with folks here, and you could see this 0.8% for 2019. Now, even if Q3, as you rightly point out, is a little bit better than what's priced in now, it'll barely improve from what's expected currently. So currently it's expected to be 0.8% positive growth Perhaps in that scenario, if Q3 turns out to be better, we'll get to 1%, 1.5%. But look at the comparison to the prior year. 2018 was a monster year from a corporate earnings perspective. So 23.3%. Anything in comparison to that will look puny and small. So we need to turn the page of 2019 to start seeing some growth, and we actually see that in the outlook. 2020, at least as currently expected, is expected to give us 10.5% earnings growth, which at this stage in the economic and earnings cycle is pretty impressive.
So you're not seeing this decline extend for a protracted period of time?
This is not the expectation, and I'm not in that camp, that bearish camp, which sees the economy as at the edge of the precipice that we are about to slide into a recession. I think the expansion has room to go. Okay. And I think these expectations for earnings growth in 2020 and also 2021, I think reflect ground reality.
Well, we're going to leave it on a positive note right there while we're ahead.
Sure.
Okay. And we'll check in with you a couple of more times.
Absolutely.
During the earnings season. In the meantime, don't you forget that you can always read Shiraz's commentaries on our website, Zacks.com. Every Monday he puts out the earnings preview, what's expected to be reported for the week in question, and then along about Thursday of every week, his earnings commentary, his earnings outlook, where he goes through the nuances of the earnings season as we go through the season. With Shiraz, I'm Terry Ruffalo.